and welcome to this quarter's House View update from Asset Intelligence as we move into the second half of what has been a very turbulent year. Those of you with a few grey hairs will know that issues which trouble the markets tend to come, make a fuss, and fade away again given a bit of time. For example, during my career alone, many stories which seemed all-conquering at the time have come and gone, from Greece to the taper tantrum to Donald Trump's China trade war. What is uncomfortable now is that serious challenges keep being added to investors' list of worries, but the previous ones are still sticking around too. In my first House View update of the year, back in January, the big issue was inflation. You'll notice that's very much still around. In the next update in April, inflation had been joined by the invasion of Ukraine. Tragically, that situation too remains very much unresolved. And now for this latest update, another fear is growing in investors' minds, the risk that we face recession. You can hear more about our views on this specific issue in our latest market update video, which you can find on social media. Broadly though, the environment seems beset by a number of stubborn problems. And against that backdrop, it perhaps comes as little surprise that only light updates have been made to the latest edition of the Asset Intelligence House View. First off, what hasn't changed? Our key overall stances on growth and defensive assets stay at neutral in each case. On growth, the investment team believe that the equity of a lot of very strong companies is now trading at attractive levels, but that these could yet move downwards in the short term as further rate rises come through. Hence our current even-handed stance. On defensive assets, the team is still wary of those areas of the universe which are particularly rate sensitive, such as bonds with long duration and low yields. More positively, we are starting to see banks and other institutions pay higher rates on cash. While it's hardly exciting and of course a very poor long-term inflation hedge, cash does at least provide nominal protection against market volatility. It's also a rare asset class which explicitly benefits from rate rises rather than being put under pressure by them. In terms of equity regions, there's little change to report. We remain positive on the UK market, which looks attractive given the healthy contingent of value-orientated stocks which feature in its large cap index. Our other key overweight view is China. Now it's true that this isn't the most comfortable of calls. Everyone on the team is certainly aware of the issues surrounding China's property market, its zero COVID policy, and the natural slowdown in its rate of economic growth. Yet, after recent outflows of foreign capital, the market has been left trading at what appears to be a very appealing valuation. And this is a bourse which includes some real big-hitting firms. Couple this with the fact that the authorities are easing fiscal and monetary policy when these are being tightened in many other markets, and on balance, we believe this is a position worth holding. Elsewhere, we remain neutral on each of the US, Japan, and emerging markets, excluding China. Each faces a complex blend of risks and opportunities at present, which in each case we believe merit taking a balanced position. You can find more on these regions in your accompanying market review and outlook document. Finally, in our world roundup, our view on Europe, excluding the UK, has been downgraded, taking it more deeply into negative territory. The continent boasts some high-quality companies, but the difficulties for the region caused by the war in Ukraine cannot be ignored. Worries surrounding the supply and prices of energy and food, along with damage to the important car industry caused by supply chain disruptions, have darkened the economic outlook and sent consumer confidence tumbling. What's more, the tricky balance faced by most central banks, trying to clamp down on inflation while leaving economies space to breathe, is even more fiendish in the Eurozone. This is thanks to the bloc's structurally high unemployment and concern over whether some governments will be able to keep servicing the interest on their debts as rates start to rise. Finally, on investment style, we're still positive on value and cyclical names given that high rates of inflation are likely to stick around for a while. However, we are keeping a close eye on growth stocks too. While we maintain a negative view in the short term, we believe that clarity on a resolution to the war in Ukraine, as well as an end in sight to rate rises, could see growth names return to favour at some point, especially if recession fears continue to pick up steam. Well, there we have it for another 3 months. If you would like further information or have any questions, please do get in touch and we'll be happy to chat. Thank you for watching and enjoy the summer.